Bank of England has just released its latest financial stability report, and it's raising serious alarms. The risk environment surrounding the UK economy has worsened. This report is not just another update. It signals that things are not looking good, and we should all pay attention. If the Bank of England, known for its cautious approach, is admitting that risks are escalating, you need to know what's really going on behind the scenes. In today's video, we'll break down what the Bank of England's warning means for the UK economy in 2026 and beyond. From overvalued AI stocks to rising corporate debt and global financial risk, we'll cover it all. You'll also get practical advice on how to protect your investments, savings, and finances in these uncertain times. So, make sure to subscribe and hit the notification bell because you won't want to miss the insights we'll be sharing. The Bank of England's latest report highlights several key economic risks for the UK, and it's a wake-up call for anyone paying attention. The global economic uncertainty remains high, driven by factors like geopolitical tensions, trade fragmentation, and stressed sovereign debt markets. These risks are making the likelihood of global economic shocks increasingly probable. Rising cyber risk and concerns about AI asset valuations are top priorities for the Bank of England. According to the bank, AI company valuations today are alarmingly similar to those seen during the dot-com bubble in the early 2000s. In fact, share prices of these companies are at their highest since the global financial crisis of 2008, which is raising concerns about a potential crash. The Bank of England warns that a sharp correction, essentially a market crash, is becoming increasingly likely. Why does this matter? Well, AI infrastructure investments are heavily financed through corporate debt, and as corporate debt continues to rise, there's a growing risk that any issues within the AI sector could spill over into the banking sector. The interconnectedness between AI companies and credit markets means that losses could quickly spread through lenders and investors, creating a chain reaction that could have disastrous effects. The Bank of England is essentially warning that we're heading toward a potential crash, one that could be triggered by a sudden correction in the AI market. Let's talk about how this could impact you personally. If you've been thinking about investing in AI or other technology stocks, now might be the time to reassess. The Bank of England's warning signals that these markets are overpriced and could be on the verge of a correction. For those of you holding investments in these sectors, it's crucial to evaluate your exposure to the potential risk. On the other hand, if you're someone with an eye on housing or real estate, rising corporate debt could also have an indirect effect. The risk lies in the interconnectedness of these markets. When AI and corporate debt take a hit, it could lead to a broader economic slowdown, which would likely have a ripple effect on the housing market and beyond. For homeowners, if you're relying on a stable economy to maintain your property's value, these risks should raise a red flag. And if you're renting, the knock-on effects from a financial collapse could cause a surge in rent prices, leaving many households under additional financial stress. Let's break down what we mean by corporate debt and why it's a problem. Corporate debt is the money that companies borrow to fund their operations, including investments in infrastructure and new projects. As businesses continue to borrow more money, the risk of defaults increases. If a company goes bankrupt or faces financial trouble, the ripple effect can be devastating, not only for its employees, but also for its investors and creditors. The Bank of England has pointed out that loan underwriting standards are weak and complex financial structures are being used, much like what happened before the 2008 financial crisis. The lack of transparency in these financial structures makes it more difficult to assess risk accurately. This is the same issue that led to the collapse of Lehman Brothers and the global financial crisis over a decade ago. To put it simply, corporate debt is rising. The risk of defaults is growing, and credit markets are becoming more fragile. This means that the financial system is not as stable as it may appear on the surface. What can you do to protect yourself? The Bank of England is essentially signalling that we need to be cautious about our investments and financial decisions moving forward. One of the first things you should consider is reviewing your exposure to AI companies and tech stocks. If these markets are overvalued, it might be time to reassess your portfolio and look for more stable investment opportunities. For those of you holding large amounts of corporate debt or bonds, it's important to consider diversifying your portfolio. Instead of relying heavily on one asset class, spread your investments across different sectors and types of assets. By doing so, you reduce your risk of suffering heavy losses if one market sector crashes. And for those who have been considering purchasing a home or property, now might be a good time to pause and reassess the stability of the housing market. If corporate debt levels continue to rise and the economy slows down, we could see an increase in interest rates and a drop in property values. Buyers should consider securing more favorable financing terms or delaying their purchase until the market stabilizes. The Bank of England also emphasizes the role of shadow banking in the financial system. Shadow banking refers to the unregulated parts of the financial sector, including private equity funding, private credit, hedge funds, and other financial institutions that operate outside the traditional banking system. While the Bank of England is concerned about the health of the banking sector, it's actually the shadow banking sector that is most at risk. Since the 2008 financial crisis, shadow banking has expanded significantly, creating new risks that weren't fully accounted for during the last crisis. If the shadow banking sector collapses, it could have catastrophic effects on the broader economy, as these institutions are heavily interconnected with the banking system. This is a key area of concern, as it could be the catalyst for the next financial meltdown. In addition to concerns about debt, the Bank of England also raises red flags about global contagion risk. The UK economy is deeply connected to global markets, including the US, Europe, and Japan. If one major financial centre faces significant stress, it could quickly spread to others. This interconnectedness creates a domino effect, where a financial crisis in one region triggers a chain reaction that affects other markets. The risk of a global contagion is heightened by the fact that many governments are already at their borrowing limits. According to the Bank of England, countries with high debt-to-GDP ratios are in a particularly vulnerable position. If the financial system faces a collapse, these governments may not have the fiscal capacity to intervene effectively. This could lead to a scenario where the financial crisis spreads rapidly, affecting the UK's banks, businesses, and households. As the Bank of England itself points out, even though UK banks are supposedly resilient, the real risk lies in the shadow banking sector. The bank's stress tests show that the banking system is strong, but these tests don't account for the risk posed by unregulated financial institutions. If the shadow banking sector collapses, the supposed resilience of the banks won't matter. For renters, homeowners, and anyone with debt, this is a major concern. If the financial system faces a crisis, households will feel the pressure. Renters could see rent increases as landlords try to recoup losses, while homeowners might face higher interest rates and a decline in property values. The risks extend far beyond the financial markets. They'll affect everyone. How are you preparing for these risks? Let me know in the comments below. What steps are you taking to protect your finances from the potential market collapse the Bank of England is warning about? If you found this video helpful, don't forget to like, subscribe, and share it with someone who needs to hear this warning. Stay ahead of the curve and stay prepared for what's coming.